Welcome to the GSMC Business News Podcast, the show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. If you're looking for a podcast to keep you informed and ahead of the game in business, the GSMC Business News Podcast has you covered. Hello and welcome to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I am your host, Sarah, and today we are going to talk about the World Economic Outlook, get an update on what is going on with that outlook. And this is an article from the International Monetary Fund. And there is tentative stabilization and sluggish recovery ? Is how this article starts out. Global growth is projected to rise from an estimated 2.9% in 2019 to 3.3% in 2020 and 3.4% for 2021. A downward revision of 0.1 percentage point for 2019 and 2020 and 0.2 for 2021 compared to those in the October World Economic Outlook. The downward revision primarily reflects negative surprises to economic activity in a few emerging market economies, notably India, which led to a reassessment of growth prospects over the next 2 years. In a few cases, the reassessment also reflects the impact of increased social unrest. On the positive side, market sentiment has been boosted by tentative signs that manufacturing activity and global trade are bottoming out. A broad-based shift toward accommodative monetary policy, intermittent favorable news on the U.S.-China trade negotiations, and diminished fears of a no-deal Brexit, leading to some retreat from the risk-off environment that had set it at the time of the October WEO. However, few signs of turning points are yet visible in global macroeconomic data. While the baseline growth projection is weaker, development since the fall of 2019 points to a set of risks to global activity that is less tilted to the downside compared to the October 2019 WEO. These early signs of stabilization could persist and eventually reinforce the link between still resilient consumer spending and improved business spending. Additional support could come from fading idiosyncratic drugs in key emerging markets, coupled with the effects of monetary easing. Downside risks, however, remain prominent, including rising geopolitical tensions, notably between the United States and Iran, intensifying social unrest, further worsening of relations between the United States and its trading partners, and deepening economic frictions between other countries. A materialization of these risks could lead to rapidly deteriorating sentiment, causing global growth to fall below the projected baseline. Stronger multilateral cooperation and a more balanced policy mix at the national level, considering available monetary and fiscal space, are essential for strengthening economic activity and forestalling downside risks. Building financial resilience, strengthening growth potential, and enhancing inclusiveness remain overarching goals. Closer cross-border cooperation is needed in multiple areas to address grievances with the rules-based trading system, curb greenhouse gas emissions, and strengthen the international tax architecture. National-level policies should provide timely demand support as needed, using both fiscal and monetary levers depending on available policy room. Recent developments and implications for the forecast. Trade policy uncertainty, geopolitical tensions, and idiosyncratic stress in key emerging market economies continued to weigh on global economic activity, especially manufacturing and trade, in the second half of 2019. Intensifying social unrest in several countries posed new challenges, as did weather-related disasters, from hurricanes in the Caribbean to drought and bushfires in Australia, floods in Eastern Africa, and drought in Southern Africa. Despite these headwinds, some indications emerged toward year-end that global growth may be bottoming out. Moreover, monetary policy easing continued in the second half of 2019 in several economies, adding to the substantial support the easing provided earlier in 2019. Its lagged effects should help global activity recover in early 2020. The 2019 growth estimate and 2020 projection would have been 0.5 percentage point lower in each year without monetary stimulus. There are tentative signs of stabilization, although at a sluggish pace. In the third quarter of 2019, growth across emerging market economies, including India, Mexico, and South Africa, was weaker than expected at the time of the October WEO, largely due to country-specific shocks weighing on domestic demand. The advanced economy group slowed broadly as anticipated, mostly reflecting softer growth in the U.S. after several quarters of above-trend performance. Despite continued job creation, in some cases in the context of unemployment rates already at record lows, core consumer price inflation remained muted across advanced economies. It softened further across most emerging market economies amid more subdued activity. Weak demand lowered metals and energy prices, which kept a lid on headline inflation. High-frequency indicators for the fourth quarter tentatively suggest momentum stabilized at a sluggish pace, helped by the broad-based shift earlier in the year toward accommodative monetary policy and fiscal easing in some countries, including China, Korea, and the United States. Temporary factors that had slowed global manufacturing, auto sector adjustments to new emission standards, a lull in the launch of new tech products, and inventory accumulation appeared to fade. Business sentiment and the outlook of purchase managers in the manufacturing sector ceased deteriorating, but remained pessimistic overall. Importantly, the new orders subcomponent of the surveys picked up, particularly in emerging market economies. Consistent with the surveys, world trade growth appeared to be bottoming out. Service sector activity, on the other hand, weakened somewhat, but remained in expansionary territory, supported by still resilient consumer spending, which in turn helped maintain tight labor markets, low unemployment, and modestly rising wages. The early signs of stabilization reinforced financial market sentiment, already shored up by central bank rate cuts. Markets appeared to have internalized the outlook for the U.S. monetary policy and the Fed's shift to on-hold forward guidance following 3 rate cuts in the second half of 2019. Intermittent favorable news on U.S.-China economic relations and diminished fears of a hard Brexit supported investors' risk appetite. Equities continued to advance in the large advanced economies over the fall. Core sovereign bond yields rose from their September low, and portfolio flows to emerging market economies strengthened, particularly to bond funds. Currency movements between September and early January reflected the general strengthening of risk sentiments and reduced trade tensions as the U.S. dollar and the Japanese yen weakened by about 2%, while the Chinese renminbi gained about 1.5%. The most notable movement across major currencies was the appreciation of the British pound, 4% since September, on perceptions of reduced risks of a no-deal Brexit. Financial conditions thus remain broadly accommodative across advanced and emerging market economies. The main considerations for the global growth forecasts from the backup of recent developments include carryover from weaker than anticipated second half outturns for 2019 among key emerging market economies, signs of tentative stabilization in manufacturing in the fourth quarter, but some weakening in the still resilient service sector activity, accommodative financial conditions, and uncertain prospects regarding tariffs, social unrest, and geopolitical tensions. We're going to go ahead and take our first break of the podcast. When we come back, we'll be talking about the global growth outlook, how it has a modest pickup in 2020. So stay tuned. You're listening to the GSMC Financial News Podcast, and I'll be right back. Are you looking for a podcast that gives you all of the latest news from the world of finance? Then check out the GSMC Financial News Podcast. We'll delve into the ups and downs of the stock market, changes in the economy, and news from the world of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we'll cover it on the GSMC Financial News Podcast. Welcome back to the GSMC Financial News Podcast and our global growth outlook for 2020, which is predicted to be a modest pickup in the coming year. Global growth, estimated at 2.9% in 2019, is projected to increase to 3.3% in 2020 and inch up further to 3.4% in 2021. Compared to the October WEO forecast, the estimate for 2019 and the projection for 2020 represent 0.1 percentage point reductions for each year, while that for 2021 is 0.2 percentage point lower. A more subdued growth forecast for India accounts for the lion's share of the downward revisions. The global growth trajectory reflects a sharp decline followed by a return closer to historical norms for a group of underperforming and stressed emerging market and developing economies, including Brazil, India, Mexico, Russia, and Turkey. The growth profile also relies on relatively healthy emerging market economies maintaining their robust performance, even as advanced economies and China continue to slow gradually toward their potential growth rates. The effective of substantial monetary easing across advanced and emerging market economies in 2019 are expected to continue working their way through the global economy in 2020. The global growth estimate for 2019 and projection for 2020 would have been 0.5 percentage point lower in each year without this monetary stimulus. The global recovery is projected to be accompanied by a pickup in trade growth, albeit more modest than forecast in October, reflecting a recovery in domestic demand and investment in particular, as well as the fading of some temporary drags in the auto and tech sectors. These outcomes depend to an important extent on avoiding further escalation in the U.S.-China trade tensions and, more broadly, on preventing a further worsening of U.S.-China economic relations, including around tech supply chains, averting a no-deal Brexit and the economic ramifications of social unrest and geopolitical tensions remaining contained. Across advanced economies, growth is projected to stabilize at 1.6% in 2020-21, 0.1 percentage point lower than in the October WEO for 2020, mostly due to the downward revisions for the United States, Euro area, and the United Kingdom, and downgrades to other advanced economies in Asia, notably Hong Kong, SAR, following protests. In the United States, growth is expected to moderate from 2.3% in 2019 to 2% in 2020 and decline further to 1.7% in 2021. 0.1 percentage point lower for 2020 compared to the October WEO. The moderation reflects a return to a neutral fiscal stance and anticipated waning support from further loosening of financial conditions. Growth in the euro area is projected to pick up from 1.2% in 2019 to 1.3% in 2020, a downward revision of 0.1 percentage point, and 1.4% in 2021. Projected improvements in external demand support the anticipated firming of growth. The October 2019 WEO projections for France and Italy remain unchanged, but the projections have been marked down for 2020 in Germany, where manufacturing activity remains in contractionary territory in late 2019, and for Spain due to carryover from stronger than expected deceleration in domestic demand and exports in 2019. In the United Kingdom, growth is expected to stabilize at 1.4% in 2020 and firm up to 1.5% in 2021, unchanged from the October WEO. The growth forecast assumes an orderly exit from the European Union at the end of January, followed by a gradual transition to a new economic relationship. Japan's growth rate is projected to moderate from an estimated 1% in 2019 to 0.7% in 2020, 0.1 and 0.2 percentage point higher than in the October WEO. The upward revision to estimated 2019 growth reflects healthy private consumption, supported in part by government countermeasures that accompanied the October increase in the consumption tax rate, robust capital expenditure, and historical revisions to national accounts. The upgrade to the 2020 growth forecast reflects the anticipated boost from the December 2019 stimulus measures. Growth is expected to decline to 0.5%, close to potential in 2021, as the impact of fiscal stimulus fades. For the emerging market and developing economy group, growth is expected to increase to 4.4% in 2020 and 4.6% in 2021. 0.2 percentage point lower for both years than in the October WEO from an estimated 3.7% in 2019. The growth profile for the group reflects a combination of projected recovery from deep downturns for stressed and underperforming emerging market economies and an ongoing structural slowdown in China. Growth in emerging and developing Asia is forecast to inch up slightly from 5.6% in 2019 to 5.8% in 2020 and 5.9% in 2021. 0.2 and 0.3 percentage point lower for 2019 and 2020 compared to the October WEO. The growth markdown largely reflects a downward revision to India's projection, where domestic demand has slowed more sharply than expected amid stress in the non-bank financial sector and a decline in credit growth. India's growth is estimated at 4.8% in 2019, projected to improve to 5.8% in 2020 and 6.5% in 2021, 1.2 and 0.9 percentage point lower than in the October WEO, supported by monetary and fiscal stimulus as well as subdued oil prices. Growth in China is projected to inch down from an estimated 6.1% in 2019 to 6% in 2020 and 5.8% in 2021. The envisaged partial rollback of past tariffs and pause in additional tariff hikes as part of a Phase 1 trade deal with the United States is likely to alleviate near-term cyclical weakness, resulting in a 0.2 percentage point upgrade to China's 2020 growth forecast relative to the October WEO. However, unresolved disputes on broader U.S.-China economic relations, as well as needed domestic financial regulatory strengthening, are expected to continue weighing on activity. After slowing to 4.7% in 2019, growth in ASEAN-5 countries is projected to remain stable in 2020 before picking up in 2021. Growth prospects have been revised down slightly for Indonesia and Thailand, where continued weakness in exports is also weighing on domestic demands. We're going to go ahead and take that second break of the podcast, and when we come back, we'll be wrapping up this episode. So stay tuned. You're listening to the GSMC Financial News Podcast, and I'll be right back. Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand. Welcome back to the GSMC Financial News Podcast and our World Economic Outlook Update. Growth in emerging and developing Europe is expected to strengthen to around 2.5% in 2020-21 from 1.8% in 2019, 0.1 percentage point higher for 2020 than in the October WEO. The improvement reflects continued robust growth in Central and Eastern Europe, a pickup in activity in Russia, and ongoing recovery in Turkey as financing conditions turn less restrictive. In Latin America, growth is projected to recover from an estimated 0.1% in 2019 to 1.6% in 2020 and 2.3% in 2021, 0.2 and 0.1 percentage point weaker, respectively, than in the October WEO. The revisions are due to a downgrade to Mexico's growth prospects in 2020-21, including due to continued weak investment, as well as a sizable markdown in the growth forecast for Chile, affected by social unrest. These revisions are partially offset by an upward revision to the 2020 forecast for Brazil, owing to improved sentiment following the passage of pension reform and the fading of supply disruptions in the mining sector. Growth in the Middle East and Central Asia region is expected at 2.8% in 2020, 1.1 percentage point lower than in the October WEO, firming up to 3.2% in 2021. The downgrade for 2020 mostly reflects a downward revision to Saudi Arabia's projection on expected weaker oil output growth following the OPEC decision in December to extend supply cuts. Prospects for several economies remain subdued owing to rising geopolitical tensions in Iran, social unrest, including in Iraq and Lebanon, and civil strife in Libya, Syria, and Yemen. In sub-Saharan Africa, growth is expected to strengthen to 3.5% in 2020-21 from 3.3% in 2019. The projection is 0.1 percentage point lower than in the October WEO for 2020 and 0.2 percentage point weaker for 2021. This reflects downward revisions for South Africa, where structural constraints and deteriorating public finances are holding back business confidence and private investment, and for Ethiopia, where public sector consolidation needed to contain debt vulnerabilities is expected to weigh on growth. Risks to the outlook. The balance of risks to the global outlook remain on the downside, but less skewed toward adverse outcomes than in the October WEO. The early signs of stabilization discussed above could persist, leading to favorable dynamics between still resilient consumer spending and improved business spending. Additional support could come from fading idiosyncratic drugs in key emerging markets, coupled with the effects of monetary easing and improved sentiment following the Phase 1 U.S.-China trade deal, with the associated partial rollback of previously implemented tariffs and a truce on new tariffs. A confluence of these factors could lead to a stronger recovery than currently projected. Nonetheless, downside risks remain prominent. Rising geopolitical tensions, notably between the United States and Iran, could disrupt global oil supply, hurt sentiment, and weaken already tentative business investment. Moreover, intensifying social unrest across many countries, reflecting in some cases the erosion of trust in established institutions and lack of representation in governance structures, could disrupt activity, complicate reform efforts, and weaken sentiment, dragging growth lower than projected. Where these pressures compound ongoing deep slowdowns, for example, among stressed and underperforming emerging market economies, the anticipated pickup in global growth, driven almost entirely by the projected improvement, in some cases shallower contractions for these economies, would fail to materialize. Higher tariff barriers between the United States and its trading partners, notably China, have hurt business sentiment and compounded cyclical and structural slowdown underway in many economies over the past year. The disputes have extended to technology, imperiling global supply chains. The rationale for protectionist acts has expanded to include national security or currency grounds. Prospects for a durable resolution to trade and technology tensions remain elusive despite sporadic favorable news on ongoing negotiations. further deterioration in economic relations between the United States and its trading partners, seen, for example, in frictions between the United States and the European Union, or in trade ties involving other countries, could undermine the nascent bottoming out of global manufacturing and trade, leading global growth to fall short of the baseline. A materialization of any of these risks could trigger rapid shifts in financial sentiment, portfolio reallocations towards safe assets, and rising rollover risks for vulnerable corporate and sovereign borrowers. A widespread tightening of financial conditions would expose the financial vulnerabilities that have built up over the years of low interest rates and further curtail spending on machinery, equipment, and household durables. The resulting renewed weakness in manufacturing could eventually spread to services and lead to a broader slowdown. Weather-related disasters such as tropical storms, floods, heat waves, droughts, and wildfires have imposed severe humanitarian costs and livelihood loss across multiple regions in recent years. Climate change, the driver of the increased frequency and intensity of weather-related disasters, already endangers health and economic outcomes, and not only indirectly affected regions. It could pose challenges to other areas that may not yet feel the direct effects, including by contributing to cross-border migration or financial stress, for instance, in the insurance sector. A continuation of the trends could inflict even bigger losses across more countries. So what are the policy priorities then going forward in 2020? The risk of protracted superglobal growth remains tangible despite tentative signs of stabilizing momentum. Policy missteps at this stage would further enfeeble an already weak global economy. Instead, stronger multilateral cooperation and national-level policies that provide timely support could foster a sustained recovery to the benefit of all. Across all economies, a key imperative, increasingly relevant at a time of widening unrest, is to enhance inclusiveness, ensure that safety nets are indeed protecting the vulnerable, and governance structures strengthen social cohesion. That is all the time we have for today's episode of the GSMC Financial News Podcast. If you are a fan of this podcast, please go ahead and follow us on social media, like and reshare posts, etc. And if you are so inclined, subscribe to the podcast and give us a lovely 5-star rating. We would always appreciate it. That helps us get our podcasts out to more listeners, which is something that we would very much like to do. So thank you so much for joining me on this episode of the GSMC Financial News Podcast. Join me again next time. In the meantime, I hope you're having a wonderful week. Thank you. You've been listening to the GSMC Business News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at gsmcpodcast.com. Download our podcast on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you have enjoyed today's podcast.